If you've got $1 million to spend, you walk into a Ferrari dealership and you're told to walk away. Rolex make 1.3 million watches a year. If you take the absolute combined production of the next 8-9 luxury watch brands, Rolex still dwarfs them. And it's the same with Louis Vuitton. My argument is this: don't buy the Hermes bags, buy the Hermes shares. The notion of exclusivity and scarcity and rarity is now seen to be a falsehood.
Hero or sidekick?
Welcome to the Sidekick podcast, where we uncover the hidden superpowers that drive some of the biggest and fastest growing companies and successful names in the business world. I'm Bryce, and I'm joined by my regular co-host Ren, and we are your trusty sidekicks. Ren, how are you going?
I'm very good, Bryce. Very excited for this episode. Today we are talking about an industry that has captured the attention of so many investors, not just from an investing point of view, but also from what they want to spend their hard-won gains on. We're talking about the luxury goods industry, and to do it, we are joined by Danny Younis. Danny, thanks for joining us today.
It's a pleasure to be here.
So Danny is Executive Director at Atomic Group, but previously was a Senior Analyst at Shaw & Partners, where covered a lot of these stocks that we're talking about and has a keen interest and knowledge in luxury goods. So that's where we want to start, Danny. Why your interest in luxury goods? What's the history? What really draws you to it?
Well, many years ago, before I spent 20 years in financial markets. I actually worked in the film industry. Okay, so I ended up going to lots of film premieres and first nights and so forth. And you always have to get dressed up. So that was my first inkling that I had to be a pretty stylish sort of person to do that sort of stuff. The second bit is really around my grandparents. My grandparents were both tailors. And so that really leveled off on me in terms of where my interest wanted to go as well. I've always been interested in fashion. And the next logical step was to move into luxury. And why is luxury so interesting to me? It's not only because I live and breathe it in terms of, my daily life, wearing it, all that sort of stuff, and being a big consumer of it for many years. But it was also because I love the psychology of it. Okay, and the psychology of luxury is, it astounds me. It astounds me that super premium priced luxury goods and services have such huge demand enabled to them. And the psychological basis behind why human beings or why shoppers purchase luxury is endlessly fascinating to me. And because it's often a completely irrational response to something that may not be rational in the first place. And I think that's the interest in it.
Well, that irrationality is probably a good introduction into this economic phenomenon known as a Veblen good. Now, I think that's probably key to understanding a lot of what we're talking about today. So can you explain what that is?
Yeah, the Veblen good is a theory espoused decades ago. I think it was about over 100 years ago, and probably even longer, by an economist with the surname Veblen. And effectively what he said is it was one of these irrational precepts that says as the price of a good goes up, in normal economics or as a normal customer, the demand would actually usually fall off, okay? But luxury is an exception. In the case of luxury, usually, not in all cases, but usually when prices go up, the demand also goes up proportionally. Okay. Now we see that in a lot of luxury goods, whether it be handbags, watches, wines, whiskies, etc., and it's usually tied into exclusivity and rarity. Yes. Okay. So, and the interesting thing with luxury is the greater the quantum, the increase in that price. If you go up 10%, you'll get a 10% increase in the demand. But if you increase it 100%, which is not an exceptional circumstance in luxury, you'll get an exponential increase also in your demand. And I find that endlessly fascinating. So it's one of the rare exceptions that you find around economic theory and practice.
Is there like a specific luxury good that you can think of that sort of exemplifies that?
Oh, there's a couple. So one of the obvious ones is in wine. So one of the world's most sought after wines is called Domaine della Romani Conti, DRC for shorthand. Now they make 6-7 wines. Their top wine on average only makes 5,000 bottles a year. Okay. That's 5,000 bottles on average every year for the whole world. Hotels, restaurants, customers like myself, bottle shops, gaming casinos, etc., etc. It's not a lot when you consider Grange here in Australia is 30,000 cases, or Bordeaux, the Bordeaux First Class, Margaux, Lafite, Mouton Rothschild, Aubryon, etc. They're 30 to 40,000 dozen. Okay, so 400,000 bottles. So you're looking at 5,000 bottles for the whole world. It's basically 2 football fields in terms of the vineyard size. And because of climate change, it's probably going to reduce going forward in terms of that average. What we find with DRC wines, the Romani Conti, when it's released every year, typically it's a 10-20% increase in price, but the demand is overshooting that 10 to 20% increase. Wow. Because 5,000 bottles isn't a lot, but the number of wealthy or high net worth individuals in the world is growing exponentially as well. You've got India coming on board, you've got China coming on board, you've got Southeast Asia coming on board, Middle East is killing it as well. But you've almost got a locked production supply. So that's a classic example of where prices go up, demand exceeds the price premium.
Is it delicious wine?
It's fantastic.
Yeah, you've tried
it? Let me tell you, this is one of the interesting things about wine investing. You know, I used to buy this wine 3-4 years ago for about $5,000 a bottle. And if you go back 10 years, it was probably $2,000 a bottle. If you go back 20 years, it was like $700 a bottle. These bottles now sell for $30,000 to $40,000 each at auction.
Wow.
What?
Okay. So, you know, if you'd bought it 10, 20 years ago, you'd be making 20 times your money. Now you're probably only going to make 2 to 3 times your money because the arbitrage in investing in luxury has really gone. If you had first mover advantage in terms of having access to an Hermes Birkin bag, for example, for $10,000, or a Rolex Panda for $15,000, or a bottle of DRC for $5,000 to $15,000, depending on which of those 7 wines, that arbitrage has largely gone because the pricing now in retail is now getting as close as possible as it can to the resale market.
Yeah, okay. Yeah.
So with these bags, with these watches, and with these wines, you're probably only at best going to make 2.5 times, 3 times your money. The days of having 10 baggers, 20 baggers, still not bad, but the days of making 10, 20 baggers, I think, are long gone.
Yeah. So I think that introduces the next part of the luxury conversation, and the part that gets investors really exciting, which is some of these companies, some of these assets have been incredible performers. A lot of people have probably heard of LVMH, but there's so much to this industry that we want to unpack. But to do it, Danny, we've been doing a little bit of research in preparation for this episode, and you have ridden the luxury train, the rocket ship, whatever you want to call it, well. We hear that you own a wine portfolio that between 2003 and 2023 has delivered a compound annual growth rate of 56%. Correct. Cop that, ASX 200. Yeah. That's beating the NASDAQ, you know?
Yeah. No, look,
so let's use that as into just the growth of this industry.
The point to be made here is if you want to invest in this industry, you've got to look long term. It's with any asset, whether it be traditional assets, such as property, equities, debt, commodities, whatever, or non-traditional assets, wine, whiskey, watches, handbags, vintage toys, classic cars, whatever. You've got to hold on to these things for at least 10 years. That's the first thing. The second thing is you've got to have access to this stuff. Okay. Now, I was very lucky when I started out on my wine collecting journey 30 years ago. I never pivoted it as a wine investment. It was never something for me that it was going to be a business and that I was going to end up selling and taking a profit, being a so-called flipper. It was always a passion for me, and it's still a passion. So over the last 25 years, I accumulated a lot of these bottles. I ended up with 8,500 bottles. That doesn't include the 1,500 that are all around the world that somehow I've still got to get back into Australia.
Wow.
So I had 8,500 bottles. I was paying $60,000, $70,000 a year in storage fees. It was becoming ridiculous. My bed was hitting the ceiling and my partner was complaining. It became absolutely outrageous.
Yeah.
Okay, so I had to cut down, and I drink 150 bottles of wine a year.
Wow.
Being an ex-analyst, I got a spreadsheet on all this sort of stuff. So I had like 90 years worth of drinking. I wasn't going to live for another 90 years. But the point here is when I started 20, 25 years ago, 30 years ago, I put my name down to all these mailing lists that were even back then had a big reputation. Okay, very small, minuscule production wines. Rockford, Wenduri. And I just kept buying these wines every year. And then 10, 15, 20 years passes by and you end up, you get hundreds of bottles of these things. So I was very fortunate in what I ended up buying ended up being a lot of the stuff that was being in demand. So it was fortune and luck as well. So it's long term. You want to hold the asset for 10 years. You want to put your name down to as many things that you think at that time are likely to do very well or have a good reputation, whether it be by points or whatever. And a lot of it is luck as well. And so you're absolutely right. The luxury industry in general, outside of wine, has done exceptionally well. If people keep banging on various posts, and even in the New York Times recently, they keep saying buying a Birkin or a Kelly is one of the best investments you can make. Well, I disagree with that. And I disagree with that because, number one, you're not taking into account the pre-order spend that's required to buy that Birkin. So if you want to buy a Birkin bag, for example, say average price $10,000, you've got to spend $20,000 effectively to buy one. Okay, so people don't include that in the cost. People don't include the liquidity issue. If you've got a bag collection worth $1 million, 100 bags, you try selling that at the moment. I follow all the Christie's and Sotheby's auctions. The sell-through rate on a lot of these bags is incredibly low. Okay, the market for these bags is very, very small. And it's really only a small selection of bags that do well. 99% of handbags are a waste of money. You're not going to get your money back. Okay, you're going to lose 60, 70, 80% of your money on them. It's only really, I've assessed, around 5 to 10 bags that consistently do well on a resale value. Right. And it's really only 4 when you break it down, okay? It's 2 Hermes bags, Kelly and Birkin, and it's the 2 Chanel bags, 255 and the classic flap. Okay, so you've got to be very, very selective. So it doesn't take into account the maintenance spend as well. You got to keep these things in great nick. You've got to hold the boxes, the receipts, all that sort of stuff as well. So there's a whole plethora of things that aren't taken into account. Now, when that study was done, I think it was done by Bag Hunter in 2016-17, they tagged it or compared it to the gold price, saying, it's beating the gold price. But gold that year had one of its worst years in decades, okay? My argument is this. If you have $10,000 or $100,000 or $1 million to invest and you want to do it in bags, don't buy the Hermes bags, buy the Hermes shares. Because if you look at the Hermes share price over the last 5, 10, 20, 30 years since it listed, you're talking over 5,000% since it listed.
Has the Hermes share price outperformed the best Hermes bag?
Absolutely, by significant multiples. I did a calculation on one of the articles I wrote recently about 3 months ago, where if Posh Spice, Victoria Beckham, who has 120 bags, conservatively estimated at around $2.5 million value. Okay, she would have paid $1 million for those bags. Okay, there are some exotic materials in there, some rarities, but now conservatively worth about $2.5 million. If at that same time she put that $1 million into Hermes shares, she would have made 13 times her money.
Wow. I love that.
13
I love
times.
that stat. That's good.
So people often forget that. So be wary of those charts that you see that bags or watches are going to outperform the NASDAQ or the S&P or gold, because it's a point in time. You're comparing a composite index such as the NASDAQ to a one-product company. So my retort to that is compare it to the underlying company's share price, in this case Hermes.
Yeah. Now, there's so much to unpack there. Watches we want to touch on. We'll go back to bags, but I want to hold on wines for a second, and I want to just double-check the 56% compound annual growth rate.
Absolutely.
Does that factor in the 150 bottles a year that you were drinking out of the...
Absolutely. Yeah. So
wow.
as an ex-analyst, my spreadsheet was better than any financial model I'd ever built on a company. So it's something like 90 megs. It's a huge spreadsheet with like 40, 50 tabs on it. And I cross-cut it and analyze everything, by grape, by variety, by year, by vintage, by everything.
So some may say that would take the fun out of it, but they don't work in finance.
No. Well, being an ex-analyst, I love this sort of stuff. Excel for me is one of the world's great inventions. That CAGR is absolutely correct. And as I said, it was because I held on to these assets for so long. So that's the first rule I said. The second rule is I consistently bought good quantities. Okay. And the third rule is often to get these wines or other assets such as bags, you've got to buy them every year. In a lot of cases, that bottle of Romani Conti that I told you about, to get one bottle of those a year, you usually have to spend like $50,000 a year with a retailer. So there's an embedded cost with everything with these things. But you're absolutely right. And in actual fact, if I look over the last 6 months, because I'm still selling wines, because I've still got thousands of bottles, my CAGR is exceeding that now. I reckon it'd be over 60%. Wow. So the market is weak. We can talk about that a little bit later. The market for luxury in general is now very weak, and there's various reasons for that. But you're absolutely right. If you hold on to the assets and you get in early and with a little bit of luck, you'll do well.
But look, we're not just here to talk about wine investing. We're also here to talk about the companies behind these luxury goods because they've been big winners. And we've mentioned LVMH a couple of times, but that isn't where the list ends. So maybe can you just give us a bit of an overview? What are some of the listed companies that have really led in this space?
So you can break it up into different pools. So right at the top, you've got really the big three. Okay, the big three are conglomerates. So conglomerates are those that own multiple brands. And the biggest is LVMH. Okay, LVMH is like towers above any other luxury goods companies. It owns about 75 brands. A lot of the ones Fendi, Christian Dior, Tiffany's, Louis Vuitton, Bulgari. multiple brands, okay, across. And interestingly, in wines and spirits, they got 25% market share with the two biggest brands globally. Veuve Clicquot, Moet de Chandon. So they are the behemoth in the industry. This is a business that's 380 billion euro. So they would be the biggest by far. And when you look at the total addressable market for luxury goods spending on a personal basis, they would be close in terms of their revenues, which is about 85 billion a year. They would be about a quarter of the total luxury goods spend. That's how much reach they have across those 75 brands. So they're the biggest. The second biggest would be Richemont. So Richemont are famous because they own Cartier and Van Cleef. So they're more what's called hard jewellery, okay, as opposed to apparel. Fantastic business. It's done well over the last 12 months. That's just under 100 bill euro market cap, okay? Very strong company, doing really well, as I said. And again, they own a whole plethora of brands as well, particularly in watchmaking. So they own a lot of independent watchmakers. The third brand is Kering. Kering is more on the apparel side. Okay, it used to be called PPR, and before that it was Gucci. And effectively, because Gucci is their biggest holding. But some of the brands they own apart from Gucci is Balenciaga, Saint Laurent, etc. So again, but they're less on the hard jewellery side and more on what's called the soft side. Okay, so they're your conglomerates. Then you go to what's called the mono brands, and it's the mono brands that have done really, really well in the last 2 to 3 years, and particularly since COVID. And we'll get to the reasons why, because it's actually pretty interesting. And the biggest of those is Hermes. Okay, so Hermes, by size, by both revenue and by market cap, would be probably the third or fourth largest luxury goods company in the world, which is astonishing for a single brand company. So that's at roughly 300 billion euro. It's huge. Wow. And you look at the 20-year chart of this thing, it's astonishing. What they have achieved is absolutely extraordinary. And there's peculiar reasons why they've done so well at the expense of others. The other mono brands that have done really well in the last 2 to 3 years are brands like Brunello Cucinelli. So very, very strong on raw materials, very, very strong on that made in Italy aspect. They're very strong on cashmere-related products. In terms of the luxury pyramid, they're right at the top in terms of their apparel pricing. Where most companies would sell men's suits, for example, for sub $3,000, you won't get a suit for less than $6,000, $7,000 at a Brunello Cucinelli. So they're playing right at that top, and they're really pushing that old heritage, like Hermes. They're pushing heritage and raw materials and craftsmanship and artisanalship. Okay, so they're another good example of those mono brands that have done really well. Some of the others that, when you look at outerwear, for example, Moncler is another one. I mean, it has other brands, but Moncler is their main brand. It's about 80% of their revenues. So in terms of, they've done really well over the last 3-4 years as well. So they're the mono brands. And then you go, it's a big step down when you go to all the other luxury goods companies that aren't only listed in Italy or in France. Prada's another great mono brand that's done exceptionally well. So when you go, you got Ralph Lauren. People would argue maybe that's not luxury, okay? But you've got Capri and Tapestry in the US, and they own a suite of brands as well. For example, Versace, Jimmy Choo, etc. So those brands haven't done as well because they've really spread themselves thin globally in terms of number of stores, price inflation, which has really hurt them. And they're backpedaling now. And you've got other mono brands that haven't done well as well. Zegna's, although Zegna now owns Tom Ford Beauty. And you've got Hugo Boss, and you've got Mulberry, and you've got Burberry, which has had its own problems. They've had mixed success because of various reasons that we've just discussed around, pricing inflation, losing customers, growing too aggressively in terms of their store networks, losing their brand DNA and integrity, etc.
So you've just given us a huge list of companies, and I guess as investors, we want to try and analyze them. And I think there's some specific things that you can think about for any company. You mentioned they're spreading themselves too thin and not having a good retail network and the like. But then I imagine there's some really specific things in the luxury market, and it's quite ethereal things like brands and stuff like that. So when you think about the superpowers that have driven the best of these luxury brands, what are you looking for as an investor?
Yeah, it's a great question. That's the core of what drives performance in the luxury goods sector. If I went back 40, 50 years ago, luxury was really only for the select 1%. It was all about haute couture with Coco Chanel, Pierre Cardin, Yves Saint Laurent, etc. And it was a very, very small market that really marketed to the rich. And there's still remnants of that today, with Queen Rania from Jordan, for example. She still remains one of the biggest luxury goods consumers in the world. But luxury has become a lot more accessible now. So what do you look for now in terms of the winners and losers? Well, the first thing is, in my view, the price-quality disconnect, I think, is at the widest it's ever been. Okay, COVID was a boon and actually something really bad for luxury at the same time. COVID drove up demand because as you were all stuck at home, you didn't know what to spend your money on, you couldn't go on experiences or holidays, etc. So people, shopped online. So luxury goods companies took advantage of that, ramped up pricing every year. On average, luxury goods brands raised their prices 5 to 7, maybe 9% per year. But during COVID, we saw prices going up 20, 30%, particularly amongst brands such as Chanel, every year. So it got to the stage where within 5 years, the price of some Chanel handbags had doubled, gone from $5,000 to $10,000 a bag. But the quality hadn't increased. They had changed nothing. In fact, in the case of Chanel, they'd reduced the quality because what used to be 18 karat and 24 karat hardware on their bags is now gold plated. And they moved from lambskin to corrected and bonded grain in some cases. Okay, so the price quality disconnect, I think, is one of the first things that really impacted how luxury goods companies have performed over the last 2 years coming out of COVID. Now, Hermes has done so well because they've increased prices only moderately over the last 3 years. On average, 6 to 7% per year. Nothing like everybody else. Gucci was one of the worst, and that's how they got into problems. All of a sudden saying we wanted to move from luxury into ultra luxury. Okay, and they couldn't do that because the demand wasn't there. Predominantly their customer base, and this is the next interesting thing about luxury, or the next thing you should be looking at, who is the customer base? The top 1% will always buy luxury goods, whether it be Ferrari, Patek Philippe, or Hermes. Okay, those customers are embedded and they're not going anywhere. In fact, they're going to grow because you got more coming out of the Middle East and Asia now. The more fashionable luxury brands, or what's called the masstige or accessible brands, such as Gucci, Balenciaga, etc., they targeted the mid-level people, the people who are aspirational, the people who are on the street, who maybe weren't millionaires or wealthy, who are earning $70,000 to $100,000 a year, but who could afford a $5,000 watch or a $3,000 handbag. That market has been decimated in the last 2 years with the whole cost of living thing. Okay, so your customer demographic is exceptionally important. The other key thing that a lot of the companies that haven't performed well have in common is they all jumped on short-term trends. They all jumped into China very quickly, hedged all their bets, all their eggs in one basket into China, and now they're feeling the impact of that. Swatch Group was a classic case, and all of a sudden that watch market there is dead. Gucci were the same, where they were opening up all these stores in Shanghai and around China. Again, that was a real issue there. There's other things that have really impacted the sector as well. The notion of exclusivity and scarcity and rarity is now seen to be a falsehood. The millennials and Generation Z, or Generation Z, are really driving luxury goods consumption these days. Now, they're 24/7 digital natives. 20, 30 years ago, you believed what a luxury good company told you about their product. It's made, handmade, in our workshops, spending 40 hours, and it's all the best quality materials. Now, on your phone, you have the whole world at your fingertips. You can assess whether or not those claims are true or not. And in many cases, we know they're not true. A lot of this exclusivity and rarity, and particularly the ruses they push around this stuff, around making you wait in line, for example, making you do pre-orders, making you buy stuff that you don't want to get stuff, all that is a ruse. You look at Rolex, for example. Rolex make 1.3 million watches a year. That's 3,000 watches every single day of the year, including weekends. And right now, while we're talking, they would have made over a dozen watches. Okay, it is massive. If you take the absolute combined production and revenues in this case of the next 8, 9 luxury watch brands, Rolex still dwarfs them. That's how dominant it is in the industry.
Wow.
And it's the same with Louis Vuitton. Louis Vuitton has 500 stores globally. Its handbags are mass-produced. Mass production is part and parcel of the luxury goods industry, but they dress it up and market it and promote it as something that's exclusive and scarce. It's not. Look at Porsche, for example. They make 300,000 911s a year. It's a lot of cars. Look at Dom Perignon, for example. They make 6 million bottles of champagne a year. And the margins on that are fantastic. $400 a pop. It's a marginal cost to produce those wines. Okay? And in a lot of cases, you don't even have to advertise this stuff. Advertising is one of the big costs of luxury, which could be 25, 30% of the overall cost base. Same with Birkins. Birkins, no marketing team, no promotional. You got people waiting 3 years, and they make 120,000 bags a year. Okay, so That exclusivity and rarity factor, I think the market now has disowned it. They don't believe it anymore. Still, there are very exclusive and rare brands. Patek Philippe is a classic example. It cannot make more than 70,000 watches a year. That's why the average entry price is, $60,000, $70,000 for a watch. I find it extraordinary. If you've got $1 million to spend, you walk into a Ferrari dealership and you're told, no, you can't buy a car. In what other industry would you have a customer would have $1 million to spend and you're told to walk away and come back in 2-3 years? It's extraordinary. I want to go back to an earlier point. I want to look at some of the financial metrics that you should really look at if you're looking at a lot of these luxury goods companies. These are very, very healthy companies. Gross margins are typically 70-80%. EBITDA margins are 30 to 50%. They spin off all this cash. They've got fantastic levers on their operating expense lines to really, bring down that. They push hard on their leases, in their A-grade locations. You've got your staffing costs. And as we know, as we saw recently with the sweatshops in Italy employing Asian labour to produce a $57 Dior bag that they on sale for $3,000, you've got levers to play around with that marketing spend as well. So the margins are very healthy. They've got a lot of room to manoeuvre and to play around with. They're very smart operators and they know how to make money. They're cash flow generating businesses.
All right, well, Danny, we're going to take a very quick break. And on the other side, we're going to look at what the future holds for the luxury goods market. This podcast is brought to you by Superhero. Are you looking for a way to level up your investments in 2025? With Superhero, you can invest in Aussie and US shares and earn Qantas points when you trade.
That's right, you can invest and be rewarded with Superhero. And to kick off the new year, Superhero is giving you a chance to win a share of 5 million Qantas points, with weekly prize winners drawn until the 10th of March.
So what are you waiting for? Link your Qantas frequent flyer account and start investing with Superhero and go in the draw to win today.
Offer ends 8th of March. T's and C's apply. Authorised under New South Wales NTP 12120, ACT TP 250024 and SA licence number T2514. Superhero does not provide financial advice that takes into consideration your personal objectives, financial situation, or particular needs. All investments carry risk, so please consider carefully before making any investment decisions and seek independent financial advice.
Welcome back to Sidekick. We are here with Danny Younis talking about the luxury goods market. We've just covered off some of the superpowers behind those conglomerates and the mono brands that you've spoken about. But Danny, the last sort of 12 months has been particularly difficult for the sector as a whole. LVMH particularly has been down. So where do you see the market going from here? What's your general outlook?
So generically, if I speak on a more broad basis to begin with, just to give you the context, in general, 4 out of every 5 years, if you go back in history over the last 30 years, 4 out of every 5 years in luxury has been up, in terms of share price performance. And in terms of really the sales and the turnover basics. It's really only 1 in 5 where they don't, So luxury goods has always been a good investment for long term, The second thing I would say is it's encumbered a lot of problems over the last 12 months, which they're currently navigating through. Things like ubiquity, being too accessible, being on every street corner. Things like, counterfeits, which are now becoming acceptable amongst younger demographics. That is sort of taking the taint off as well. Things like becoming homogenous. Everything is luxury these days. Down to $15 lipsticks and perfumes up to, multi-$1,000 goods. So it's become absolutely homogenized. It's lost its exclusivity. It's lost its desirability in many cases. And I'm speaking broadly here because there are always exceptions to each one of these things I say. The unethical and sustainability things that have been shown up hasn't helped it as well. A lot more people now are a lot more sceptical as to the claims that are being put forward by luxury. You've got declining quality. You've got poor value for money in many cases, as we saw with Dior and that disconnect I talked about earlier. You got the illusions around exclusivity. So there's all this sort of stuff. One of the worst things they actually did was move into streetwear, in my view. They went too heavily into streetwear, and that really tarnished the brand image and the brand DNA. $2,000 sneakers, $1,500 T-shirts. It got ridiculous. Trucker caps for $1,500. So what do they need to do now? To really maintain performance going forward? Luxury in general, historically over that last 30-year period, has grown typically at twice the rate of GDP. So 6 to 7, 8% growth per annum. And I think long-term, that's where it'll get to as well. If you look at the forecasts out by either Bain or Altagamma or McKinsey's or any of the brokers, such as CLSA, etc., out to 2030, they've really got those 7 to 9% rates going forward. It's going to be rather flat this year, if not negative, but longer term, you're still going to get those growth rates. But there's a few things they need to face in terms of challenges the next one. So the first one is the rise of the resale channels. You could argue it's a positive for them as well because it gives increasing brand DNA integrity to these brands in that you can sell them for much higher prices. Now, resale has become a really big thing. So you want to be able to offer a product to your customer that you know is not going to lose massive amounts of value. Okay, that's the first thing. Second thing is the rise of online. In terms of digital adoption, we've seen that amongst the young demographics, huge. Okay, I remember 5-10 years ago, I would never bought a pair of shoes or even some clothing online. Now I think most people do it routinely. Same with suits or whatever. Now people spend $10,000 on a watch or a handbag online, sight unseen. Luxury goods companies have been very, very slow to adopt online, and I can see why. They want to control the customer. And a lot of companies such as Chanel and Hermes won't put their most sought-after products like their Birkin bags online. You have to go in store for that sort of. You've got experiences. So COVID really drew upon moving from being stuck at home into moving back into experiences. And luxury goods companies have been very, very slow in adopting experiences as opposed to products. Other things that I think they need to do is they address counterfeits. That's always a big issue. But I think now, in many cases, they're largely acceptable amongst certain demographics in the community. So there's all these parameters that they're dealing with. But long term, I am still comfortable that they can grow at 6 to 9% per annum long term. Okay, there's obviously going to be cyclical dips, etc., such as we'll see this year, and that's dependent on what happens in China and the US, which is still the biggest market at about 25-30% of luxury good spending.
Nice.
Now, Danny, one final question. Mainly investors watching this and listening to this, and the good news is if people are interested in buying the sector as a whole, there is that Lux, LUXX ETF listed over in the States, but available to buy on Superhero if people just want exposure to the industry.
Absolutely.
But we want to get you to be a little bit more specific as we close it out. Are there any particular stocks or particular assets that you think are really, capturing your interest now and you think will be really interesting to watch over the next couple of years?
You've got to go by track record. The absolute standout in the sector consistently, whether you go back 1 year, 3 year, 5 year, 10 year, 15 years, not going to be a surprise here, Hermes. It has consistently outperformed because they've stuck to their strategy. They've never veered away from that strategy. The story they're selling is it's an artisanal business. It's full of craftsmanship. It's all about handmade quality for most of the goods, the leather goods we're talking about here. Very high margins, very limited marketing spend, superbly managed. They're not focused on creative directors and designers to drive the brand. They're not fashion forward. They don't jump onto short-term trends like moving into China and online and all these sorts of things. They know who their customer is. They know how to sell to their customer. And it's superbly managed both in terms of physical management and in terms of financial management. So that would be the clear one. The thing is, it's close to 60 times on a PE basis. Okay. It is not cheap.
Yeah.
But if you invested across those time periods that I just alluded to, 5, 10, 15, 20 years, you would have made your money back multiple times, more than any other company in the sector in most cases. So that would be my number one pick. Second pick would really be around LVMH. You with a conglomerate that size that dominates the share of wallet so much globally, and with such strong brands, and it's trading at a multiple of currently 25 times, so half Hermes, it is very, very hard to bank against LVMH. Bernard Arnault, who, whatever point you look at his wealth, he's one of the richest men in the world. Could be the richest today, second or third. Very, very smart operator. He buys these cheap assets. What he did with Dior back in the 1980s and 1984, how he bought that business, is a masterstroke of genius. He got it for a song. He saw the potential of it, and he built this massive conglomerate. So very smart. He's got all his family members now, his sons and daughters running the businesses. He owns most of the company, obviously, but the free float is still fantastic. So LVMH at 25 times, long term, will continually do well. If you go a little bit smaller, it's hard to say. A lot of them go through cycles. I mean, Prada's done well the last 3-4 years, particularly on the strength of Miu Miu. But if you go back 10 years ago, it was struggling. It was loss-making. So you've got to be able to ride out these cycles. But they'd be the two I would pick.
Nice. Love that.
Unfortunately, Australia doesn't have any luxury goods companies. So Oroton I used to cover many, many years ago. Pseudo-luxury, but yeah.
I reckon if there was a...
Treasury, look, they promote themselves as a luxury brand, particularly around Penfolds Grange. My view is it's probably not 100% luxury. It's because it's a mass product, doesn't have the pricing premium. The resale values are super low. So at this stage, no, unfortunately.
No, it's a no deal.
a
Well,
no
Danny, thank you so much. Left us with a couple of stocks there to think about, but that was fascinating. I don't think we've ever gone so deep on luxury. So really enjoyed that, and I know everyone listening will have plenty to think about. So thank you very much.
No, thank you. Pleasure to be here. Thanks a lot.
And if you're interested to learn more about growing your wealth like a superhero, head to superhero.com.au/registration.
And don't forget to subscribe to Sidekick wherever you're listening or watching so you don't miss an episode. That's it from us, your trusty sidekicks. We'll be back uncovering more superpowers next episode.